Security markets. What is the securities market? It's where exchanges of securities, such as stocks and bonds, take put based on request and supply. Securities markets decide cost and members can be both professional and non-professional. It's a common term for portraying the markets in stocks, bonds, and other securities such as alternatives and funds. Keeping up to date with what's happening within the securities market is imperative in case you're an investor. So there are two levels of securities markets. First, primary markets are where new securities are issued, whereas secondary markets are where existing securities are bought and sold. So, what is primary market? Primary markets are where new assets are advertised to investors for the primary time. The cost you'll see is set by the vendor, ordinarily a company or government. One of the most celebrated primary markets is at the London Stock Exchange. Primary markets regularly hit the headlines when a huge energizing company is arranging an initial public offering, IPO. What is IPO? An IPO is the first time that a company offers shares or floats to the public on a stock exchange. What is shares? In financial terms, the official share definition is a unit of ownership of a company or financial assets. This will be the primary time investors can purchase offers in these companies, so they'll flock to primary markets to form a deal. Next is, what is a secondary market? A secondary market is one where investors can exchange money, related items with other financial specialists. It works like a second-hand market, and that financial specialists purchase and offer utilized instead of modern stocks, bonds, options, or futures. Stock markets and secondary markets are frequently thought of as the same thing, but stock market is a more common term that incorporates primary markets as well. The price of secondary market stock is set by supply and request, whereas on the primary market, companies can set the cost of their stock. Investment banks as well as corporate and private people can all exchange on a secondary market. So there are three categories of securities. First, securities, second, debt securities, and derivative securities. So equity securities, this is often just a luxurious title for stocks. After a purchase offers you possess portion of a company. So equity securities, another common instrument of investment for organizations investing in cash equivalents, is common and preferred stock. Buying equity in other organizations can provide a variety of benefits depending on the scale of the investment being made. Equity investments tend to yield higher returns at higher risk, while also granting shareholders a percentage of ownership over the organization being invested in. Next is debt securities. Also known as fixed income securities, these are superior known as bonds. The most common type of debt securities are corporate bonds, government bonds, and money market instruments. Bonds function in fixed term contracts, generally long term, offering a fixed rate of return at an extremely low level of risk. The reason the risk is so low on these particular instruments is due to the fact that in the circumstances of a bankruptcy or default on payments on behalf of the representing organization in commercial bonds, the company who issued it, and on government bonds, the government that issued it, the holder of a debt security will be among the first stakeholders paid out when assets are liquidated. Next is derivative securities. With this, you're allowed the right to exchange money-related securities at pre-agreed terms rather than owning offers by and large. Perhaps the most interesting marketable securities and often the highest risk are derivatives. As the name implies, derivatives derive their value from the performance of an underlying assets. These underlying entities can be indexes, assets, interest rates, or a variety of other financial devices. The reason they can be so dangerous is due to the fact that a derivatives of another assets they can be subjected to an application amplification of the risks the underlying assets is subjected to. The 2008 economic recession is largely due to the irresponsible utilization of derivatives. In that case, primarily those reliant upon debts such as home mortgages.